Please take notes. While trading can be rewarding, it comes with high level of risk and you can lose all your funds. And also note that videos on this channel are for educational purposes only. None is intended as investment advice. Please do your own research and also consult your financial advisor if you need one. Thank you. All right, you're welcome back. So, lesson 1.4 deals with reading currency quotes. Okay, so we are going to look at currency pairs and quotes. Now, currency quotes can be presented in two ways. You have the direct quotes and you have the indirect quotes. Now, it's not something out of the blues, it's not something difficult to understand. Let's look at direct quotes quickly. When the domestic currency is the base currency, now when you hear the word domestic currency, there is a convention already in place. Okay, so we'll just say you can't change it. That's the way it is. For example, when you have USD JPY, this conventional standard, the domestic standard is USD must come first before JPY. So USD becomes the base currency and JPY is the quote currency. All right, so this actually shows how many Japanese yen are needed to buy $1 in the direct quote. But then you have the indirect quote. An indirect quote is when somebody turns it the other way, right? So instead of you having the domestic currency coming first on the left, you now have the other currency, all right, coming first, just like the opposite of what we just had in direct quotes. Instead of USD JPY, you now have JPY USD. And what this is showing you is how many US dollars are needed to buy one Japanese yen. And if the value of USD JPY is 146, for example, 146 yen, and now you turn it the other way, indirect quote, one Japanese yen will be going for a fraction less than one US dollar. Hope you got that. Now let's quickly look at bid and ask prices. We talked about bid and ask prices earlier on in the earlier lesson, but then the bid price here, going into more details, is the price we mentioned already at which the market will buy a specific currency pair from you. For example, in the case of USD JPY, okay, so the bid price, all right, is the price on the left side, which we're going to show you shortly, all right, is the price that the market is willing to buy it, is going to buy it from you. All right, you receive it as a quote, so you choose to accept or reject it. Conversely, the ask price is the price at which the market will sell the currency pair to you. Now, remember, as we always say, the bid price is on the left side while the ask price is on the right side, and the bid price is usually lower than the ask price. Take note. Now, the difference between these two prices, bid price and ask price, is what is known as spread. And spread represents the broker's profit from the trade. When you enter a trade, as soon as you enter that trade, profit or no profit, the broker has already made their own money as soon as you close the trade. So once you enter the trade, the broker's profit is marked out. That's why every trade you enter comes with a negative balance instantly. Initially, you enter. So it's either 3 pips, minus 3 pips, or minus 2 pips, or minus 1 pip. So the broker already makes the profit. Okay. So some who do not, who give you zero spread, immediately enter the trade, you see commission. Okay. A tighter spread often indicates a more liquid market. Pips and lot sizes. So a pip is an acronym for percentage in points. So in the stock market, they deal with points, all right. And so, but in forex, we deal with percentage in points, which is pip. And this pip is the smallest price move that a given exchange rate can make based on market convention. For most currency pairs, a pip is typically the fourth decimal place, e.g., you have 0.0001. Okay, and like in the opening of this lesson, you saw a Euro USD at 0.7 something, 7 into 4 digits, right? Okay, so that's the pip. The any numbers or digits after the decimal point, that's pip. So the from it count from the last digit. In this case now one, all right, it can rise to 0001, 0.0002, 0.0003, and so on. So the only exception to this are pairs that involve the Japanese yen. And for such pairs, one pip is the second decimal place. You see, in the conventional quotes, all right, one pip is the fourth decimal place. But for Japanese yen pairs, one pip is the second decimal place. So Japanese yen pairs will include USD JPY, Euro JPY, GBP JPY, CAD JPY, AUD JPY, and any other NZ JPY, any other JPY pairs you can think of that exist in the market. Lot sizes. Now, lot sizes refer to the quantity or number of currency units you are trading. Now, the standard lot size, which is acceptable in the market, is 100,000 units, which is the standard lot size. And for such, all right, when price makes one pip move, the value of that pip is usually 10 US dollars, except for Japanese yen pairs or cross pairs. Should I say cross pairs? For pairs that, yeah, for cross pairs, for cross pairs where the US dollar is the base currency. For pairs where the US dollar is the base currency. I think that's what I wanted to clarify. For example, USD JPY, USD CHF. For these two pairs, sometimes it's usually higher than $10. Sometimes it's lower than $10. The reason is because you're going to be dividing the 1 unit of the US dollar by whatever price that is. I will exemplify it shortly with the calculator so that you see it. We'll just go to a chart and we'll see it before we wrap up this session. Okay, so the standard lot is usually 100,000 units, where one pip is $10. Then you also have the mini lots, which is 10,000 units, where one pip is $1 equivalent, and micro lots of 1,000 units, where one pip is 10 cents. So understanding lot sizes is very, very crucial for managing risk and position sizing. You'll understand it by the time we get into the practical section of this course. Now, let me take you to the chart and explain this quickly before we make progress. Okay, so look at this now. I'm going to open USD JPY. Okay, so this is USD JPY, and let me pull out a calculator quickly. Now, you see USJPY, the price for USJPY is, let me set this on scientific. Okay, all right, and set it here. Okay, now look at this. USJPY here is 144. Let's pick any one of them, 144.75. So one pip there, so $1 divided by that value, you have 144 point whatever you can see, seven we can grab. Okay, 6.9. So when you place a trade now, one pip will be 6.9. Let's just try it. One standard lot. You can see that. Let's do a sell. Okay. Okay, now you can see what's going on there. This is a fraction. You can see one here now. If you take you can see six. Okay, that's 6.5. Let's just see again 10 here. Let's just be watching. You can see. Okay, so when you look at that, it gives you the exact just I think it's just moving, so it's equal to quickly pick it. But I'm sure you can pause the video and do the calculation. You'll see that it's just around that value. We're going to do a check for another one. We'll close this trade, then we will open another one. This is a demo account, mind you. So we are not really bothered about. Okay, so let's close this, and you can see. So let's close this. Now let's open to USD CHF. Let's open to USD CHF. Okay, so for USD CHF, see here the value here is the value we have here for USD CHF is um, 0.84. Okay, so you can say $1 divided by 0.84008, whatever. You can see here now, okay, this is 1.19. So here now, one pip for the US dollar will give you about $11, higher than $10. You can see that. So that's how the calculation is done. Okay, so that's how it is calculated. So if you have anyway, by the time we really get into the practical section where we'll just be dealing only with the platform of the charts and your smartphone, you will understand better. Okay. So let's quickly summarize this lesson 1.4. Currency pairs are quoted with a base currency and a quote currency, indicating how much of the quote currency is needed to purchase 1 unit of the base currency. Quotes can be direct or indirect depending on which currency is the base, whether it's the domestic currency or not. The bid price is what the market will pay for a currency pair, while the ask price is what the market will sell it for, with the difference being the spread. And pips represent the smallest price movement in currency pairs, and lot sizes determine the quantity. Okay, remember also that spread is what your broker makes each time you open and close a trade. Whether you are profitable or not, it doesn't matter. The broker must make that money. All right, remember that risk disclosure still says that everything we put up here is strictly for educational purpose and not intended as investment advice. Do your own due diligence and research, and please consult your financial advisor if you need one. All right, go ahead and leave a comment by asking your question. Anything you want to know, just leave it in the comments. You can also check in the description to join us on our channel where you receive free trading signals to really build and boost your confidence in trading. You can really be profitable. All right, so see you in the next lesson. Thank you very much and God bless. Did I say subscribe? Yes, subscribe also.